The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
We were down, then up, another bumpy ride on Wall Street. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. Initially, it looked like a big two-day decline, but we've given that back, and we're now up on the day, at least for now. The S&P 500 in the green, up by 0.2%. At one point, it did fall as much as 1.5%, and stocks briefly entered a correction down 10% from the recent high. You're seeing the VIX come back a little bit, too. Now at 26.5, at one point it was approaching 30. Of course, we are seeing some give back at the rally in treasuries, so lower price, higher yields. You can see the yield on the 10-year moving up 7 basis points to 4.28%. However, the loonie is in focus right now. It is green. You can see the dollar losing ground versus the Canadian currency. Of course, you remember that President Trump says he is doubling tariffs on Canadian steel and aluminum to 50%.
All right, so Carla, right now the S&P off to its worst start of the year. A correction territory, down 10. Okay, look, this is a rip the script up kind of day here because it is another wild day on Wall Street. The S&P was in correction territory. It's now in the green, and there was a lot of concern about an official close to that drawdown, which would actually bring an end to a bull market that began back in October of 2022. Enough so much that Citigroup strategists today had to downgrade their view on stocks for the next 3 to 6 months to neutral. And a big part of that is the idea that U.S. exceptionalism, if not dead, is at least on pause. And while the policies coming out of Washington are certainly to blame for a lot of that, a lot of this really we saw coming. The public voted for it, Trump promised it, and now we're getting it. It's the flip-flop, the back and forth. Those long-promised Trump tariffs on steel and aluminum, they do take effect tomorrow. But even as we speak, the negotiations continue between Canada and the U.S. Will he or won't he? That's the erratic nature of the White House, and that has been the erratic nature of this market. Where do we go next? I don't know. But we had a chance to catch up with Larry Summers earlier today, and he says it's not necessarily the impact of the tariffs that we should be worried about, but it's the process. Listen.
I think you have to say that there's in the range of, I'd say still slightly below, a 50% chance of a recession starting this year.
And it's not just hyperbole either. American Airlines yesterday said its first quarter loss is going to be roughly double its prior guidance. Delta Airlines yesterday cut its profit outlook in half. In fact, the CEO there, Ed Bastian, calling this year so far, quote, a parade of horribles. And we also got weak forecasts this morning out of retailers Dick's Sporting Goods and Kohl's. So a lot of alarms are being raised about the strength of this economy, particularly as consumer and business sentiment sour.
Absolutely. And let's zero in on the consumer because their spending really drives the U.S. economy. More than a quarter of those surveyed in a New York Fed survey believe that their year-ahead financial situation will be somewhat or much worse off. So you're looking at this jump here to 27.4% in February. That marks the highest reading in about 15 months. The survey also finds that consumers' outlook for overall inflation does hold steady at around 3%, even as they see faster price growth for the essentials. We're talking about gas, food, medical care, and rent. So you add it all up and you get a growth scare that now has investors worried about a potential recession. Romaine?
Let's kick things off to the close. Liz Ann Sonders, the chief investment strategist with Charles Schwab. And Liz, I always love talking to you on days like today because I have no idea what's happening today. We were in correction territory in the S&P. Then it does appear that there is some sort of concessions being made either on the U.S. side or the Canadian side that's now getting stocks at least back up to the waterline. Makes sense, not just of today, but really the last 3 or 4 weeks here where I think the market is just kind of listless.
Well, lovely that you think I know any better than you do, Romaine. That this is a bit chaotic just in terms of the manner that we're getting these announcements. And I think what's important is we know we're going to get these knee-jerk days. I think today and the reversal was a combination of whatever negotiations are happening between the United States and Canada with regard to the increased tariffs that have been put on, but also news about a potential ceasefire between Russia and Ukraine. So I think that was enough in a very oversold market to bring some buyers back in. And in fact, it's interesting today because the three best performing sectors are what we call the growth trio: tech, communication services, consumer discretionary. That's what houses the Magnificent Seven. They're at the top of the leaderboard today. And at the bottom of the leaderboard our year-to-date leaders, healthcare and staples. So you're still getting a lot of whipsaw action, and it's certainly tricky for long-term investors, really tricky for traders. And I think that type of backdrop is likely to continue, at least near term.
Are you actually encouraged, though, at all by some of the price action we've seen over the past couple of weeks? Because you talk about this idea of those three sectors that you mentioned with regards to tech and discretionary being up. And that seems to suggest that there are a lot of people that really do want to be invested in this market. They just want maybe a more stable backdrop, I guess, in which to do it.
Yeah, and I think sector rotations on a day-to-day or weekly basis are likely to continue to be fairly fierce. I mentioned just the differential between the action today versus year-to-date. Healthcare is the best performing sector year-to-date. Only 1 week, and it was last week, was it the best performing sector in the week. So you get these wild swings. And broadly, it's this shift from defensive positioning to maybe hopes that we get a little bit more of a cyclical lift. We also are very oversold in a lot of segments of the market. We talk about the absence of a correction yet at the index level for the S&P, but at the average member level, the maximum drawdown this year is 14%. It's more than 30% for the NASDAQ. So that does breed opportunity. It's often found under the surface. And I think the fuller story of what's going on in the market is told under the surface of the indexes, because the indexes are still biased by the larger names. This recent period of time, it's been large cap value that's been the driver, but there's still that large bias. So it's important in that backdrop to look under the surface of these cap-weighted indexes.
People talk about how sentiment has really taken a very hard turn. Anxiety has basically replaced optimism inside of 3 weeks. How much of this is being driven by the Trump trade simply being unwound? And if so, how far along that process do you think we are? Are we like 2/3 of the way through that?
Well, here's the rub. You can look at investor sentiment as falling in one of two buckets, either attitudinal measures of sentiment, survey-based data, or behavioral measures of sentiment. So the one that's gotten a lot of attention recently is American Association of Individual Investors, that saw a huge surge in the percentage of bears and a big plunge in the percentage of bulls. The rub is that even AAII actually does a survey tracking the equity exposure of their members. And equity exposure is only about 2 percentage points off what was near an all-time high, this recent cycle high. Only last week did we start to see it show up a little bit in fund flows. The week before last week, you had $24 billion come into U.S. large cap equity funds. So it's more of a, what they're saying suggests a lot of bearishness, and maybe some complacency has come off the boil and froth has come off the boil, but it hasn't really been matched on the behavioral side yet. It's when you see the combination that tends to serve as a little bit more definitive a contrarian indicator.
Okay, so as we see firms like HSBC or Citi reduce their weighting in U.S. stocks to neutral from overweight, that's the call, but it hasn't necessarily been followed up by action just yet, has it?
Well, in terms of just expressing bearishness about the U.S. equity market, but not having adjusted positions, that's the differential. And that's not uncommon. When we had the first big whoosh down in the 2022 bear market into those June lows, you saw it on the attitudinal side, a record amount of bearishness, but it wasn't matched on the behavioral side. It wasn't until October that you saw the combination of behavioral panic and kind of, attitudinal panic. We're more in that mid-year 2022 backdrop from a sentiment perspective, and that's what I'm keeping an eye on.
I am curious, Lizanne, as we get sort of deeper into the year, with the assumption that maybe some of the chaos in Washington dies down a bit here, do you see any sort of material chance of getting back to those all-time highs, or at least close to them, and which were, I think, just 3 weeks ago?
Sure, I think it's possible. It probably would take a combination of things, certainly more certainty on the policy front, inclusive of tariffs, and maybe some of these tariffs being taken off, or a little bit more of a common thread of what the plan is, as opposed to the fits and starts of announcement. That has obviously fed into confidence. It's part of the reason why, alongside tariff mentions going parabolic on quarterly earnings call, we just finished reporting for the fourth quarter. We had a very strong fourth quarter with the benefit now of hindsight, but it's not translating into better numbers for any of the 4 quarters in 2025. So I think it would also have to manifest itself in some stabilization in that downward trend to 2025 earnings estimates, because although we've eased some of the valuation excess from last year, courtesy of a correction, we still have that decelerating denominator in terms of the E and the PE. I think you would need to see some stability there too. That also requires less uncertainty.
All right, Lizanne, I have to leave it there. Always wonderful to talk to you on update, down day, or any day in between. The Chief Investment Strategist with Charles Schwab, kicking us off to the close as the President of the United States continues to speak about the tariff situation, now saying that he may back off doubling those steel and aluminum tariffs to 50%. Remember, they were originally supposed to be 25%, taking effect tomorrow. We're also learning that Ontario's Premier Doug Ford is scheduled to be at the White House on Thursday, it appears, to meet with Howard Lutnick and some other folks. This is driving the market, a market right now that is focused on the impact of those tariffs and of those Washington policies on the economy. We've heard from a lot of companies, including the airlines, concerned, and retailers. Kohl's and Dick's Sporting Goods, both of those stocks sliding on the day after both companies issued disappointing outlooks. Scarlett.
It's not just the biggest businesses that are worried either. The NFIB's latest small business survey shows optimism fading and economic uncertainty rising in that cohort. We're going to speak with a woman behind the survey, Holly Wade, Executive Director of the NFIB Research Center.
And a conversation with Michael Gapen, the chief U.S. economist over at Morgan Stanley, on why the latest update to his forecast sees higher inflation later this year. All that and more coming up in a bit, right here on The Close on Bloomberg.
Well, it's pricing it in. Copper is, is heading towards $5 a pound right now. But I think aluminum is the one to really watch, because the question is, can you onshore aluminum production? And the answer is absolutely not. If you think data centers and AI are power intensive, aluminum smelting is in a whole different world. It's 6 times more power intensive per dollar revenue than AI data centers. So if you're already power constrained, there's no possible way you're going to bring all of this aluminum smelting into the United States.
That was Carlisle's Chief Strategy Officer of Energy Pathways, Jeff Curry, speaking with our very own Alex Steele earlier today about bringing manufacturing back to the U.S., particularly when it comes to aluminum. They're speaking at CERAWeek in Houston. I want to continue the conversation now on these tariffs on aluminum and steel imports from Canada and bring in Ed Gresser. He is Vice President and Director for Trade and Global Markets at the Progressive Policy Institute. Ed, great to speak with you. I want to get a sense, first of all, because tariffs on aluminum and steel imports is not new. We saw this back in 2018. What was the cost of it back then, and how does that change in 2025 with the currently proposed 50% tariffs?
Well, the cost of it then was 25% tariff on most steel, 10% on most aluminum, and with exemptions for most of our imports from Canada and Mexico. So Canada supplies 6 million tons of steel a year, Mexico about 3 million. Canada supplies about 60% of all the primary aluminum we use in the United States. So this is a big change, a big increase in costs for manufacturers, for cars, for appliance makers, for home builders. It looks to me like the White House is trying to run a higher cost, higher price economy, and viewing that as a way to increase the manufacturing sector in the United States. I don't quite see the logic of that.
Well, I am curious. I mean, when we talk about at least the shorter term impact of this, is the idea that things will still be made, things will still be sold, but there'll just be a higher price tag on them? Or should we kind of prepare ourselves for the idea that there will just be less supply of those things? And I'm talking more about the finished products out there, Ed, whether it's cars or even something as pedestrian as, an aluminum baseball bat for our kids.
It's a little bit of both. The long-term effect of the last round of steel and aluminum tariffs has been the reduction in use of steel and aluminum in the United States. So we used to use about 100 million tons of steel. Now it's about 93 million. Aluminum use is down as well. As home builders and as construction companies and as manufacturers try to economize and use less of them because the price is higher. So you're going to see some higher prices of consumer goods some attempts by the users, using industries to economize. And at the end, the manufacturing sector, goods using sectors are a little bit smaller. That's a longer-term outcome. Short-term outcome is higher prices for consumer goods and also for industrial construction.
Ed, you led the economic research unit at the U.S. Trade Representative's office during the first Trump administration. And I'm curious as to how much modeling there was for different tariff levels back then. I'm just trying to get a sense of the process and thinking for how they're going about coming up with these tariffs this time around. Sometimes it feels like it's by whim, and it certainly comes off that way, but I'm guessing that there is some work being done behind the scenes.
First time around, I don't believe there's a lot of modeling for the metals tariffs. There was a lot more preparatory work done for tariffs on Chinese goods, and they did try at that time to focus on tariff increases on things that were more easily substitutable that you could get from other countries, and things that were kind of less consumer sensitive. I don't think that was true of the metals tariffs back then, and I don't think the outcome shows a lot of foresight. This time around, there's a lot less foresight, you can tell. I've never seen a case where the U.S. government announced 3 different tariff systems within the space of a week.
Yeah.
And that just causes chaos. And it's not possible that they've thought this through in advance. This is reacting to events on the ground and trying to hit back when Canada hits back against us.
Assuming these tariffs do go through, Ed, are you worried at all about an economic downturn, if not a recession altogether?
Well, there will be less growth than there would otherwise be. Imports are about 13% of GDP. You can overstate the damage that trade reductions can do to the U.S. Mm-hmm. But the International Monetary Fund says it like this: a big increase in tariffs plays out like a negative supply shock, reducing output and adding to inflation. That is what the outcome will be. How large it is not quite sure. But you can definitely see, as you've been talking about, a lot of uncertainty and a lot of red lights flashing on the dashboard. Yeah. GDP growth estimates, financial markets, consumer confidence. You can see the administration shifting gears from saying last year we'll defeat inflation and quickly bring down prices to access to cheap goods is not the essence of the American dream. Yeah. It's very strange to see that sort of shift in rhetoric. Yeah. And it suggests that they don't see things looking very good ahead.
All right, Ed, great stuff. We have to leave it there. Up against the break here. Ed Gresser, Vice President and Director for Trade and Global Markets at the Progressive Policy Institute. Our focus on the economy today and a focus on the retail space. Dick's Sporting Goods, those shares down after its profit outlook trailed street expectations. We'll discuss next in Top Calls with a big focus on the economy. And here's a big focus right now on commodities. If you're wondering what all this tariff news means for the markets, take a look at what it's done for copper on the day. This is Bloomberg. Over the last 24 hours, we've heard from several consumer-facing companies saying that they are expecting harder times up ahead. That includes the airlines like Delta and American, and it also includes Dick's Sporting Goods. The shares right now having their worst day going back to August of last year after issuing a disappointing outlook for this fiscal year. Joining us right now to talk a little bit more about this is Michael Baker, Senior Research Analyst over at D.A. Davidson. He's got a buy rating on the shares. All right, Dick's was doing okay prior to, I think, some of the concerns out there. Is this something that might be short term, meaning whatever concerns they have about consumer spending, that this might be something that just might be a quarter or two, or should we gird ourselves, investors gird themselves for something a little bit more long term?
Well, it is a challenging environment right now. But for Dick's, they just comped at 6.4%. They're not really seeing much of a slowdown. Now, their first quarter guidance is closer to 3%, so I suppose you could call that a slowdown, but no one's going to guide to 6% in this environment. So as the CEO said to us, this is an appropriately conservative outlook But I wouldn't characterize it as any kind of major slowdown in what they're seeing. In fact, they continue to take market share, and their business is actually doing very well. So I think it's a market overreaction with the stock down about 6% today.
How do things hold up going forward, Michael? If we do get some economic softness, how do you view DICS? Is DICS discretionary? Is it staples? I mean, for those of us who have kids, I mean, it's basically a consumer staple. But I assume for other folks, it might be discretionary.
Well, it's a little bit of both. And you bring up a good point. If we do go into a recession, unless things get really bad, you're probably not pulling your kid out of Little League, or she is probably still playing basketball. So you still need that kind of equipment. Perhaps you could trade down a little bit on your golf equipment or something along those lines. But
no, Michael.
Yet. God forbid, I know. But Dix isn't seeing that yet. But I suppose that's the sort of negative case. But for now, their business is holding up really well. And there's a case to be made that in a tougher environment, people maybe exercise a little bit more, try to, focus on their mental health a little bit, buy some sneakers and go out and hit the road. So we think it holds up pretty well in a challenging economic environment, at least better than other, sort of more discretionary names.
For the record, Scarlett, my wife would like me to spend less on golf equipment.
Well, I mean, you're going to defy that because it's clearly a staple for you, Romain. All right, let's talk a little bit about Dick's own investments. It's clearly spending money to grow. It opened 7 House of Sport locations and 15 Dick's Field House locations during 2024. It's got other plans to kind of continue doing that in 2025. How much does that constrain gross margin?
Well, actually, the gross margin's been really strong. I think, in each of the last 6 quarters, guiding to up again next year. These investments are helping them sell higher margin, better goods. That's contributing to the gross margin. Another one that is maybe a little bit under the radar screen is their Game Changer business, which is a software as a service type business where it sort of hooks into little leagues, baseball and softball players, and it allows you to keep score. But a very high margin business, growing about 40% year over year, with we think could be upwards of 70% gross margins. That's a key driver to their gross margin going higher. Now, they are investing in that, adding talents, data scientists, et cetera, but that's going to pay off over time with much higher gross profit dollars.
Okay, you have a buy rating on the stock and a price target, I believe, of $280, if I'm looking at that correctly. Is that still the case?
Thereabouts. We're adjusting our models, but it won't change much. As good as the stock has been, and this stock was up 55% last year, it was up 22% the year before that. It's still, prior to today, just trading at about 14 times earnings. It's still a pretty cheap stock with the pullback today. And again, estimates might come down a little bit, but the stock is down more than the estimates will come down. So it's probably trading at 13.5 times. To us, that's a great value for again, a name that is taking market share with higher gross margins.
All right, Michael Baker over at D.A. Davidson, thank you so much for joining us today. Again, a buy rating here on Dick's Sporting Goods. $280 price target is pretty aggressive given where it's at right now. But as he makes clear, investing in youth sports, I mean, that's a staple. That's what people are going to continue to spend on.
Yeah, and it's interesting. I know he doesn't cover Kohl's, but we should just kind of mention that as well, because they also gave a somewhat dour forecast going forward. And those shares are really taking it hard on the day. But it gets to this idea here, as if there is a slowdown in spending, there are certain things that we have to keep spending on.
Yeah, absolutely. Yeah. All right, coming up, we're going to talk about small businesses because their optimism is getting tested by uncertainty from tariffs as well as consumer spending. Our conversation next with Holly Wade, Executive Director of the NFIB. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romain Boston.
And I'm Scarlett Fu. We're looking at a market that's just bouncing around. The president is speaking right now. He's made some comments about not being at all worried about the stock market declines. Yeah. And not worried about the recession as well, or a recession, I should say.
Yeah, he said he's not paying attention to it, but we talk about the moves, the big moves that we saw in this market. We only opened down about 0.2%, but at one point in the day, we were down more than 1%. Mm-hmm. And in that correction territory, 10% drawdown from that record high back in mid-February.
And of course, we're continuing to keep an eye on what this means for consumer spending, because the tariffs could raise prices for consumers all around, but in particular for lower income consumers who spend more of their income on goods than others. You look at the NFIB Optimism Index for small businesses, it fell last month as businesses opt to pause their investments as they weighed out what's happening with policy, further assess the Trump administration's policies, which seem to be ever changing. For more on this, let's bring in now Holly Wade. She is Executive Director of the National Federation of Independent Business Research Center. Holly, it's good to speak with you. And what strikes me when I look at the data points from NFIB is how much has changed inside of 2 months. We really have gone from one extreme to the other.
We've seen a bit of moderation in our index from the post-election spike that hit 105. We're now down to 100.7, still a few points above the 51-year average of the survey. So we're still in a pretty good space as far as small business owner sentiment in February. So the respondents were, for the first half, most of them from the first half of February, where there was a lot of discussion about current changes in policy, but has largely kind of been removed from what we've experienced over the last 2 weeks.
And when it comes to things that they're worried about, inflation is up there, but it's actually number 2, which surprised me.
It is. So labor and labor issues related to finding applicants for those very high, historically high levels of open positions that they currently have, and also labor costs. So those two have kind of outpaced the inflation picture for at least the month of February. But still 16% are saying that inflation is their single biggest problem. Some of that may be coming from compensation pressures. Still, a lot of small business owners are saying that they've increased compensation for retention and recruitment of those positions that they are eagerly trying to fill. And so a lot of cost pressures continue, but labor is the name of the game right now for a lot of small business owners, especially in the construction and transportation industries.
Do they still have that pricing power, Holly? I mean, the surveys seem to indicate that they are raising prices. They have the ability to do that?
Well, they're certainly trying to absorb some of those increased input costs that they continue to experience. Fewer are saying that they're planning to increase prices going forward. So that might be a signal that they're, feeling a bit under pressure about further increases going forward. But, with 16% saying that it's still their top issue, it is a concern for them in trying to absorb those higher costs, especially when it comes to, again, the input and inventory costs of those products that are in short supply. I mean, I can't believe we're still talking about, bird flu and eggs prices and chickens at the moment. But, it's still on the table, unfortunately, for a lot of them, trying to figure out how to absorb those costs, pass them on to customers, how much they can pass along, and how frequently.
I am curious, though, how this affects their psyche longer term here, because in the survey, we talk about more businesses now indicating that they're going to pause new investments, primarily because of current conditions. How quickly can that change to positive, or is this something that just lingers even if economic conditions themselves do turn positive?
Well, I think a lot of it has to do with the uncertainty, how they see investing in their business, making plans for capital expenditures that have, fallen off quite a bit over the last year. So whether that's related to financing costs of those projects or just concern about the general economic conditions in which they're operating, as those, if they start feeling more confident about how those are evolving as as developments get settled, they might then start thinking about picking up the pace in investing in their business going forward. So I don't think it's long term. Things could change quite rapidly. We've seen that in the past of them picking up speed in that area. But right now they are more of them are pausing on investing in their business.
Holly Wade, Executive Director of the National Federation of Independent Business Research. Those NFIB numbers out earlier this morning. That had a big impact on how we opened today, and now the tariff talk having a big impact on maybe how we finish. Stuart Kaiser joins us right now, Citi's head of U.S. equity trading strategy. And we should point out, Stuart, the President of the United States, speaking at the White House, and just moments ago, he was asked specifically about whether the sell-off concerns him. His exact quote, nope. Does it concern you?
Well, at least he was concise. Yeah, it does concern us. I mean, there's three reasons why we're not kind of buyers of the dip here, and the absence of a quote-unquote Trump put is key to that list. It's probably number 2 out of the 3. Mm-hmm. I think if you listen to Trump or you listen to Secretary of Treasury Besson over the last 2 to 4 weeks, they've been sending a pretty clear message, and that is to hedge and to protect your portfolio, and we would listen to them. So it is concerning. Yes.
So how do you do that in this environment?
Yeah, I think it depends on the risk you're trying to hedge. I think the biggest impact on the markets lately, frankly, has been positioning risk and the concentration of positioning, particularly in large cap tech stocks. So we've been recommending using NASDAQ puts as a way to hedge that. Those have gotten a little expensive, but in our view, that is the key risk to the market. So you might as well hedge it directly, even if it costs you a little bit more.
What does positioning look like right now? Because Citi and HSBC, the research side, have all downgraded the U.S. stocks, their weighting in U.S. stocks to neutral from overweight. Have we seen people move their positioning to that level, or is that something that's going to take a couple of weeks to really unfold?
Yeah, I think you got some time there for that to work out. I mean, if you think of investors have been buying these large cap tech and growth stocks for the better part of 2 years, right? It's hard to rebalance that position, that quickly. Our conversation with clients suggests that positioning, quote, de-risking or repositioning probably 7th or 8th inning. So you're getting near the end, but you're not all the way there. I think there's a little distinction though between the positioning and then the research side of the house kind of getting a little more neutral. I think that neutral call, yes, it depends on positioning, but also I think it depends on things like increased risk of recession, the negotiations on tariffs, what's going on with the budget and tax policy. So I think the broad-based economic and policy uncertainty kind of also plays into that as well.
You had mentioned that there's no Trump put, and many people had expected one. How much of that is because people were looking for the market's narrative to play out the way it did during the first Trump administration? They were using that old playbook.
Yeah, I think that's 100% the case, and the view that that Trump really values the performance of the financial markets. But I think what you're hearing from the White House and from the Secretary of Treasury is, yes, they do care about the markets, but they believe there are multi-year, if not decades-long imbalances that have built up on trade, budget, and fiscal spending. And to start their administration, that's their priority. And they feel like they need to deal with that first. And as a result, they're willing to accept some sort of short-term turbulence in the market as the cost of getting that done. At least that's the message they're giving us.
Is there any sort of, when you look at the price action, particularly today, does anything about it encourage you? And I ask that because as soon as we started to get these headlines that Trump was maybe going to back off on doubling the tariffs, the Ontario Premier said he would, back down on those electricity tariffs, which I never understood. And then you had some headlines coming out about a potential ceasefire in Ukraine. You saw the S&P shoot up by about 100 points off its lows of the day here. And that seemed to suggest there are a lot of people that do seem like they want to be invested in this market. They're just looking for an excuse to be invested in this market.
Yeah, I think that's right. Look, I think the bounce on the tariff news is probably less encouraging to me, just in the sense that those headlines are up and down, left and right. Mm-hmm. So, the market could just trade lower on a tariff headline tomorrow morning. I think what was most encouraging today was even when the markets were selling off, you had NASDAQ and tech stocks outperforming the market.
Yeah.
You had the key stocks that are sort of high momentum growth stocks outperforming the market. So I was more encouraged to see that and, for instance, high momentum stocks outperform the market. Even in a down tape, those stocks that we would have said are at the epicenter of the de-risking story were either up or materially outperforming today. So to me, that was the chief positive that I would take away from today.
It's interesting, too, because right now we're kind of in this weird netherworld where kind of earnings are more or less over and, we still have to wait for the Fed, but they're pretty much not going to do anything next week anyway. When we get to the next earnings season, which is really just, about 3 or 4 weeks away, is there any sense here that corporate fundamentals, or more importantly, the guidance that they give, will be enough to support any sort of upward move in valuations?
Yeah, I think it can help, but honestly, at this point from earnings, I think we're hoping that those will stabilize the market as opposed to maybe driving the next leg higher. Yeah. I mean, one of your earlier guests, kind of commented that, we saw a strong fourth quarter, but we haven't seen it flow through into out quarters. Mm-hmm. So basically, coming into the year, I think the bar was relatively high for earnings, right? It was a low teens S&P earnings growth, Mag 7 in the low 20s, the rest of the market call it 10 to 12%. Mm-hmm. That was a very high bar for earnings to begin with. And I think, frankly, if next earnings season, despite all the uncertainty and all the turbulence, if corporate America comes out and sort of reiterates that guidance, the market will respond positively to that. Does that put us to new all-time highs? Probably not, but it does stabilize the market and I think can help deter investor sentiment.
Beyond that, what other positive catalysts are you looking for? Because you're using that as a catalyst to stabilize things. I'm curious if there's something that can actually help reverse the course that we've seen, turn the correction or the almost correction in a different direction?
Yeah, I think number one is labor market and consumer confidence. You want to see that improve. Number two, which I think has been a little bit back burner, but is going to be front burner in a week or two, is congressional negotiations over the budget and over tax cuts. So assuming they do a continuing resolution, that period between, call it March 24th and April 11th, is when the rubber's going to have to meet the road on the budget and on the tax negotiations. If that stuff goes smoothly and it looks like they're able to get spending down a bit and they're going to extend the tax cuts, I think that is something that can get the market higher. Because remember, this administration has been sort of flipped over from the last time. The last time they did the positives first and the tariffs second. Yeah. This time they've been doing the negatives first and the positives second. So if we can see positive momentum on budget and tax, I think that is something that can really get us another leg higher.
Okay, so no Trump put right now and no Fed put either. Could anything come out of the Fed meeting which would move markets in a meaningful way?
Look, I would assume that the Fed would not want to introduce that risk into the system. You have a 4.1% unemployment rate. You've got inflation generally going the way they want. I think they're generally happy with the momentum. Likely they'll say something that we're monitoring financial conditions or something sort of neutral like that. I would not expect them to be aggressively dovish or supportive of the market unless we saw the labor market data pre that event sort of start to decline.
All right, Stuart Kaiser, always a pleasure. Thank you so much for coming in today. Stuart Kaiser is Citi's head of U.S. equity trading strategy. All right, of course, we are keeping an eye on the sector here that had made a lot of headlines in recent days. Airline stocks hitting major headwinds amid weakening consumer demand. American Airlines and Delta Airlines both cutting their financial forecasts. The CEO of United says the company is seeing weakness in travel demand. And those are the declines we're seeing in the shares today. Joining us now for more is Brooke Sutherland. She is Bloomberg's Boston bureau chief. And Brooke, this is a turnaround from when Delta reported earnings and was saying things were looking really good. They have all these fundamental tailwinds. How much of this is tied to just the overall economic environment and the uncertainty over tariffs and policy versus some unfortunate headlines in the last couple of months regarding airline incidents?
I think what you're seeing is more sort of a reflection of this uncertainty weighing on consumer demand. But it certainly, to your point, was not helped by that series of safety incidents that we have. I think that's just sort of an added pressure when you think about people's willingness to pay for airline tickets. And I think Delta CEO talked about it. It just further complicated the picture in this quarter. But to your point, I mean, comparing it to what we heard from these airline CEOs not that long ago, this had been a sector that really was holding up pretty well. Even as we saw consumers pull back from other categories of spending, they had been willing to keep spending on travel. And that's partly because you didn't see quite the same level of inflation in airline travel and other aspects of the travel economy as you did elsewhere. I know it probably didn't feel that way for a lot of people flying, but it wasn't as stark as what we saw in some parts of the goods economy. So this had been, a pretty healthy corner of the economy. And to see that pullback now, I think that is what's spooking investors. Now, time will tell if this is a pause or if it's more of a lasting, sign of turmoil. Keep in mind that the first quarter tends to be a pretty weak one for travel. And so I think what's going to be really important is to see how that demand fares over the spring break period. And then, of course, the all-important summer travel
give us
season.
your potential assessment of that, because it's interesting you talk about the outperformance that we saw in the airlines, an almost 50% run-up in, at least as a group, coming out of the third quarter all the way through the fourth quarter and then through January. If leisure travel, as we heard from Delta and American, might be suffering. There was a report earlier today that government travel out of Washington and beyond has fallen by like 40 to 50%. And business travel had never really gotten back to pre-pandemic levels. Is there a fourth leg to the stool that I can rely on?
I don't know what that fourth leg might be. And so to your point, I do think it is concerning to see that pullback in government and corporate travel, because the airlines were really looking for corporate travel to kind of pick up the mantle of the recovery here. We saw leisure bounce back faster coming out of the pandemic, and the airlines had been looking for that corporate travel to really start to perk up. And there were some signs of that toward the end of last year. You've also seen, I guess to your point about the airlines stock prices being up, you've seen a level of discipline with the airlines really cutting back capacity after they arguably overbuilt coming out of the pandemic, really chasing that leisure demand. So you've seen more rationalization there, which has been to the airlines' benefit and really helped, especially the leaders like Delta and United, build up their profitability. But of course, that only gets you so far, and you do need the demand side of the equation to match up as well.
Yeah, all right. Brooke Sutherland, Bloomberg's Boston bureau chief, and we should point out those airlines now down 20% on a year-to-date basis collectively here after a wonderful start to the year, a wonderful end to the year as well. Economic concerns now in focus. The president president speaking at the White House, saying he does not see a recession and he's not concerned about how his policies are affecting the economy. Here he is speaking just moments ago, right outside the White House.
What is your message, President Trump? Buying a new car while there are some folks who will see this clip at home and they are struggling with their retirement accounts down at the moment, uncertainty about work ahead.
Well, I think they're going to do great. I think our country had to do this. We had to go and do this. They've taken away, other countries have taken away our business. They've taken away our jobs. I did it initially very strongly against, as you know, China and some others in the first term. And it was a very successful term. We had no inflation. We had the greatest economy in the history of our country. And then we had COVID, which we had to straighten out. So I didn't want to be doing anything with respect to other countries at that time. And we did a great job with it. We handed the stock market over. It was higher than it ever was. And think of that, higher than it ever was to that point before. And nobody thought that was even possible. We did a great job. But we had the greatest economy in history. This economy, in my opinion, is going to blow it away. But what I have to do is I have to get the workers back. I have to get the factories open. We have 90,000 factories and plants are closed from what you had just prior to NAFTA, which is not very long ago. 90,000, think of it, 90,000 factories and plants are closed from what it was. And it's just not right. So, and we gave it away. Presidents before me gave it away, and I could name every one of them. But they gave it away, and we're taking it back. We're taking our jobs back. And one of the things I'll say, by the way, speaking of Tesla, he manufactures more cars. I mean, he opened this incredible plant, one of the largest plants in the world in Texas. Could you talk about that, Elon?
Yeah, it's worth noting that the Tesla cars have the most U.S. content of any cars on the market, so they're the most American made. We have the biggest factory and the most advanced automotive factory in Texas that we've opened and continue to expand. And so this is very much these are great products. A Model S is one best car ever. So they've all these cars have won incredible awards. So they're great cars and they're American made. And I think, try it. You'll like it. Yeah.
And I'm just saying, beyond the cars, they're great. But we have to celebrate somebody that has the courage to do this. He could have said, I'm not doing anything. I'm not going to get involved. Let the country go to hell. He didn't want to do that. And remember, he's going to find, and we're up to almost $500 billion worth of waste and fraud and abuse. $500 billion. We're giving $2 billion here, $2 billion there, not millions. It was a bet. If it was $1 million or $2 million, that's a lot of money. But we're talking about billions of dollars being given to defunct, scams. Given to people with nothing. They have nothing going. They open up a subchapter S corporation and they put $2 billion into it from nowhere. And we've caught a lot of them. I wish we could catch all of them, but we've caught a lot of them. And he's been largely responsible. So we have to celebrate him. And it's not that he's conservative. I don't even know if he's conservative. I will tell you this.
These days
I've been doing this I've known him for a pretty long time. He endorsed me. I didn't know him that well when he endorsed me. But in the time I've known him, he has never asked me for a favor. He didn't ask me for this. I said, Elon, I don't like what's happening to you. And Tesla's a great company. I don't like what's happening. It's, from our standpoint, American cars, American made. He employs thousands of people. He's got, at the same time, he has the most modern plants in the world. I said, I don't like what's happened to you. I'm going to do it. I didn't even know he was going to come. He's never asked me for anything. He endorsed me, and he never asked me. I didn't even know he was going to endorse me. The guy has never asked me. He's not saying, in fact, I could go a step further. I ended the electric mandate. Okay, I ended the electric mandate. And I figured, when's this guy calling to raise hell with me? And he never called. I mean, he never called me. If I were him, I would have called.
So on that,
because he's probably even better than I am.
Mr. President, is Elon Musk rubbing off on you? Is electric then the way to go?
It's not that this isn't for electric or gas, because people have their choices.
Yeah.
I'm just saying that I know people that have these cars. I know one man, we see him all the time. Yeah. He has 5 of them.
Yeah.
He thinks it's and he was a big guy for Ferraris and other things. And he says, man, it blows him away. I know other people, they have 3, 4, they love them. They love them. And some people like the gas, and they should have their options. Right. I'm all about options. But I'm telling you, I ended the electric mandate, and I was waiting for a call. I said, did Elon call yet? They said, no, sir. The next day, what about Elon? Did he call? He never even mentioned it to me, never complained. Until this moment, I'm just bringing it up. Who would do that? Yeah. He has never asked me for a thing. And he's built this great company, and he shouldn't be penalized because he's a patriot. He's an incredible patriot. And I don't even know if he's a Republican. I really don't.
Mr. President. Mr. President.
Well, I'm not sure if he was.
Tesla stock is
You're going to
also...
have drops, and markets are going to go up, and they're going to go down.
Yeah.
But you know what? We have to rebuild our country. Our country has been stripped of its jobs, of its factories. And I'm tired of seeing where they build apartments, cheap apartments in an old broken down factory. But you have factories all over the place that are empty from many decades ago. And we're going to change it around. And it's all taxing policy. You know, it's really a policy because we have great workers, great people. It's really a policy of taxing and incentives. And I'm bringing the incentives back. And I'll tell you what, numerous plants, and I don't want to mention specifically, but I'll mention this one. Numerous plants in Mexico and other places that were under construction or soon to be under construction are now coming here, and they've dropped that because it was unfair what was happening. Mexico, they were building cars. They were selling them into the United States with no tax, no nothing. And in the United States, we were allowing them to take our jobs and take our factories, and we don't do that anymore. Now, from a president, it would be a lot easier if I just coasted for another 4 years. I would have been an 8-year president. I had the best economy in history in my first 4 years. I would have done very well with this one. And I had a decision to make. Do I want to do this or do I not? Do I want to do it right? The right thing to do is what we're doing. We're going to get our jobs back, and we're not going to be laughed at. Now, I will say this, that already Canada, and I respect very much, as you know, there's a very strong man in Canada who said he was going to charge a surcharge or a tariff on electricity coming into our country. He has called and he said he's not going to do that. Okay, he's not going to do that. And it would have been a very bad thing if he did. And he's not going to do that, so I respect that. But we were just informed that he's not going to do that. Look, we've been treated very unfairly by Canada. We've been treated very unfairly by Mexico. But we've been treated very unfairly by every country all over the world. The European Union is horrible, horrible. And we're going to get it back. And I have a choice. I could just coast, and eventually there'd be a blow-up down the road, maybe a long way. But we owe $36 trillion, and we're going to get it back. We're the biggest, we're the best, and I'm very optimistic. I have to tell you, I'm very optimistic about the country. Much more optimistic this way than if I did it the easy way. Yeah. I could have done it the easy way. I could have coasted. Biden left us a mess. He left us tremendous inflation, tremendously high costs of products. He left us a mess, but he also left us a mess with millions of people that poured into our country that are criminals. Millions of those people happen to be criminals. And we're looking for them all over the place. We're looking for them. And Holman and Christie are doing an incredible job. But he left us a horrible situation, and we're changing it. But one of the things we're changing is we're going to make our country really wealthy again. We're going to bring our jobs back. Right now, we're like a chicken that's being plucked at from all over the world. We're not going to let that happen anymore.
Mr. President,
but very importantly, and I said it, Ukraine, ceasefire. Ukraine, ceasefire. Just agreed to a little while ago. Now we have to go to Russia, and hopefully President Putin will agree to that also, and we can get this show on the road. We can get this horrible war where 2,000-3,000 soldiers a week, every week, 2,000, 3,000, 4,000 sometimes. I get the reports. And they're not American soldiers. They're Ukrainian and they're Russian. But people are being killed outside of that. People are being killed in the cities as things explode throughout the cities. And we want to get that war over with. So I think it's a very big, I think it's a big difference between the last visit you saw at the Oval Office and this. So that's a total ceasefire. Ukraine has agreed to it, and hopefully Russia will agree to it. We're going to meet with them later on today and tomorrow, and hopefully we'll be able to wipe out a deal. But I think the ceasefire is very important. If we can get Russia to do it, That'll be great. If we can't, we just keep going on and people are going to get killed. Lots of people.
Is Zelensky invited back to the White House?
Sure, absolutely.
Mr. President, you mentioned the ups and downs in the stock market. You said it'll go up, it'll go down. But do you and your tariff policies right now bear any responsibility for the turmoil we're seeing this week?
Biden gave us a horrible economy. He gave us horrible inflation. And I think the market was going to go very, very bad. If anything, I have a lot of very smart people, friends of mine and great businessmen. They're now investing because of what I'm doing. Because long term, what I'm doing is making our country strong again, financially strong, militarily strong, and strong if we want to get away. Remember this, we have wars. When I left, we had no wars. We didn't have Ukraine and Russia. We didn't have October 7th. We didn't have that disaster that took place with the withdrawal from Afghanistan. And you look at what's happened there. We caught the major terrorists, which Biden wouldn't have caught. Why didn't he catch him? I caught him. 5 weeks into the presidency, I caught the man responsible for Abigate. And he's going to pay hell right now. He's a bad dude. He's a bad guy. But we didn't have these problems. I had no inflation. I had a great economy. He gave you high prices. You couldn't buy bacon. You couldn't buy anything. And also, I inherited a situation with eggs. The price of eggs was through the roof. Well, now the price of eggs has come down a lot. Interest rates have come down. Gasoline prices have come down. It's all coming down. It's all a beautiful thing. I can do it the right way or the wrong way. We're doing it the right way. And I have tremendous confidence in this country and the people of this country. Tremendous confidence, much more so than if I sat back for 4 years and had a good time in the Oval Office. I want to look at cars.
Mr. President, I have an announcement to make that I think would be helpful. I want to say, as a function of the great policies of President Trump and his administration, and as an act of faith in America, Tesla is going to double vehicle output in the United States within the next 2 years.
That's
double.
a big deal. That's great. Thank you. And by the way, he makes one car. This one I don't understand. This one I don't want, but that's okay. Without a steering wheel, it comes out next year, right?
Yes.
Explain that, please.
Yes. Well, the Cybercab starts production in Texas next year, and it's self-driving. We have so much confidence in the self-driving nature of it. That
You're listening right now off screen to Elon Musk, of course, the CEO of Tesla, in charge of a lot of the policy positions that Donald Trump has been trying to implement with regards to cutting what he says is waste in the government. The president of the United States standing there as well, talking about his economic policies as well. And the long game right now, not too concerned about the market, a market that did actually reel on the day, and S&P briefly dipping into correction territory as we move closer to these closing bells. Just about 2 minutes ago, Romaine Bostick here alongside Scarlett Fu. Michelle Weaver joins us around the desk, U.S. thematic equity strategist over at Morgan Stanley. And Michelle, I do want to talk about the trading range that we've seen on this market. We did dip into correction territory, and there's been a lot of talk about what that line in the sand. It clearly wasn't the 200-day moving average, which we broke through the other day. A 10% correction, maybe that's the line in the sand. I know you guys have been trying to model where that line of support is going to be. Where?
So we've been thinking about a 5,500 to 6,100 trading range for the first half of the year as the market really digests a lot of this tariff news, tries to figure out where we're going on the policy side. We think you could get more upside in the back half due to DOGE and deregulation policy. So there could be some policy upside in the back half of the year, but the first half has just been really challenging for investors to think through these different tariff plans. We model about 5 to 7% potential downside to the earnings number based off of our economist GDP forecast, incorporating that higher level of tariffs. But I think it's really important to remember that this is not going to be uniform across different industries. If you have something like utilities, super domestic, not going to see that same level of earnings impact as, say, consumer goods, which is very, very manufacturing heavy in Asia.
What's the upside?
So 6,500 is our year-end price target. So we could see more upside, but that's really back half loaded, and first half is going to be largely about these tariffs. And you're willing to stand by that right now, at least based on what we know. All right, in conversation right now with Michelle Weaver, U.S. thematic equity strategist at Morgan Stanley. She's sticking with us as we get the closing bells in New York. And I guess there is reason to clap here, Scarlett Fu. Things could have been a lot worse. An S&P 500 that was down more than 1% on the day, officially in correction territory on an intraday basis, down 10%. It's going to close just shy of that, down about 9% from its all-time high that was set 3 weeks ago tomorrow. 55.72 right now on the S&P, down 42 points on the day, 0.7%.
The Dow Jones Industrial Average down about 1% here on the day. The NASDAQ only down about 0.2%. And look at this, Scarlet Fu. If you want a bright spot, you're going to find it in the Russell 2000, higher by 4.5 points or 0.2%.
And maybe that speaks to the rotation that we've been seeing in equities, right? Everyone coming out of big growthy stocks like technology, like consumer discretionary. You look at the IMAP, it's a sea of red, but if you dig into the 24 industry groups, the 24 groups, you can see some gains in autos and components and also some chip companies as well as software and services.
I really got to squint, though.
Yeah, you do. I mean, it's not going to show up in the big, broad picture as you see there, but, break it down a little bit further, it is there because consumer discretionary as a group down 0.25%. Tech as a group losing 0.4%. Michelle, I want to come back to you in our conversation here. We talk about how you see things being choppy in the first half, but perhaps stabilizing in the second half. Is that because we are more accustomed to the tariff turbulence and the headlines that kind of keep coming, tariffs are on, tariffs are off, or is it with the expectation that the tariff stuff will be done by the first half and the second half will, everyone will move on to things like tax cuts and M&A deregulation?
So the first half, it's really just about working through this tariff instability. So whether you're an investor or whether you're a corporate CEO, if we don't know what the status quo is, it's really difficult to manage to that. It's really difficult to model to that. I was just at our TMT conference out in San Francisco, and tariffs are coming up for a lot of companies. These were in a lot of conversations. If you're a CEO, the easiest thing to do right now is really rely on pricing power. That doesn't cost you anything. You can try and control for some of the profitability impacts to tariffs, but you don't really want to go and say, okay, we're going to change our manufacturing base or we're going to set up something new that takes a lot of capital investment if we don't know what the status quo is.
But relying on pricing power means necessarily higher prices. That means inflation, and that has huge repercussions for monetary policy.
So it really, consumers have to react to that though. So companies can try to set a higher price level, but consumers need to accept that. So you will find some balance over time. I know we've got our chief economist coming on in a bit to talk about some of the implications there.
All right, we're in conversation right now with Michelle Weaver over at Morgan Stanley. I do just want to get you up to date here on some of the big gainers on the day. Despite the fact that we did end in the red, there were a lot of names that did move the market here on this day. I actually want to start, though, at the bottom of the screen there with Reddit. This was a stock, a retail favorite stock, Scarlett, that was down 50% year to date prior to today. A strong bid coming today, up 14%. Best day for that stock going back to November of last year. Tesla at the top. That's going to be a wild ride because, of course, if there's any stock that's gotten caught up in all of the chaos and hullabaloo going on in Washington, it's that stock. Getting a nice bid on the day, up 4%, at one point up more than 6% on the day. But we got to talk about Southwest Airlines. Up 8%, Scarlet Fu. And you want to know why?
Yeah,
they're instituting bag fees. That's a crime as far as I'm concerned.
They held firm to that line of how they were not going to institute bag fees for a long time before they finally caved. Activist investors, of course, have been pushing them to increase profitability. I see you shaking your head because I know you're a fan of.
Well, investors love it. Look, I know it's good for the bottom line, but as a consumer, I'm not sure I really like this. Anyway, best day for Southwest. Believe it or not, Scarlett, going back to 2020.
Wow. Well, it was the last holdout, so it did hold firm for as long as it could. Let's continue in this theme of airlines because you could see that Delta and American each tumbled at least 7%. And this is after they both cut their profit forecast for this quarter as consumers start to get a little bit nervous and edgy about prices and, of course, about the overall economy. And just want to mention as well, two of the Mag 7 names, Alphabet and Apple, extending their losses. A remedy package from the DOJ yesterday showed that the Department of Justice retains a punitive posture. So it's a sign, really, that the Trump administration is not necessarily being more lenient on the antitrust front. So, Michelle, that's something I want to bring up to you because you said you were at the conference not so long ago. How much are people talking about the posturing by the Trump administration? Because there's a lot of hope that this would be a very regulation, not free, but a light touch on regulation administration when it came to corporate M&A. And we haven't necessarily seen that. And we're definitely not seeing the M&A take off.
Yeah, so I think there could be still, room to grow for M&A. It's just, once again, with the tariffs, with the current level of political uncertainty, it's really hard for companies to make these longer-term, very expensive decisions. But I do think that there is still room for the M&A story to grow once we get past that tariff uncertainty.
Well, speaking of long-term expensive decisions, they've made a lot of decisions on CapEx, particularly when it comes to AI and that broader AI ecosystem. Now, I know the quarterly results we just got really weren't able to take into account what's been happening in Washington. But most of those companies stood by, in some cases, increased their spending plans. Is that going to stick?
I think that could stick. And what we're really seeing around AI at the conference, if I think about what was happening 2 years ago, it was the promise of AI. We got to build out these teams. We're really excited about it. Last year it was, okay, what are some low-hanging fruit? What is some early adoption use cases we can do? Things like chatbots, things like, we can make our customer service more efficient, we can make our programmers more efficient. Now what we're seeing are really these more nuanced, more business-specific use cases for AI. And I do think that people are going to continue spending there, and you are going to start to see more ROI there.
When you think about tariffs and how it's going to affect the technology sector, I mean, the chip industry is obviously front and center here, but does it automatically mean that software gets a pass because it's not something that we export in the same way that we export chips?
So, I mean, absolutely. It's similar to what you're seeing within the consumer discretionary side, where we have an overweight on services over goods. Similar thing within the tech sector. We have a preference for software because they are largely immune to that tariff uncertainty. On the other side of that spectrum, you've got tech hardware, where you still do have a ton of manufacturing in Asia. Given the uncertainty, they're not really able to think through how are we going to reorganize our supply chains until you have more certainty.
I do want to get your take on how yields factor into this. We did see an uptick in yields on the day, just by about 5 to 6, 7 basis points across the curve here. And this gets to the question, how much even can you model right now into stock valuations, given how much volatility we're seeing in the yield space? And is there going to be any shift? Do you anticipate any shift in the Fed?
So we've really modeled out 4.5 as the key level for stocks and for increasing sensitivity to that yield. And so as long as we stay below that, we think that that is going to weigh less on equity market valuation.
Michelle Weaver, really appreciate you taking time for us. Very smart U.S. thematic equity strategist over at Morgan Stanley on another volatile day on Wall Street that could get even more volatile tomorrow with tariffs set to take effect and a big economic data point. When we come back, a conversation with Zoe Liu from the Council on Foreign Relations about those tariffs, and a conversation with Michael Gapen over about what's been going on in the economic space. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostick. Another wild day on Wall Street. The markets open lower, and for a second there, it looked like they were diving into the abyss here. Though we did get some headlines late in the day where we did maybe, get some sort of potential compromise on some of those tariffs that are expected to start to take effect tomorrow. That helped lift the market off the lows, but not enough to really push it into the green. And S&P down 0.8%. That second line of your screen there, that includes a lot of the airline companies, but also a lot of the car rental companies, sort of the residual effects of some of those economic warnings we got out of Delta and American Airlines. And you see the metals and mining group there. That includes names like Alcoa, Century Aluminum, and a few others actually getting a strong bid on the prospect, though those steel and aluminum tariffs set to kick in tomorrow, borrowing some change by the Trump administration, could actually be a net positive for some of those names.
Yeah, we should mention, of course, President Trump speaking earlier saying that he is looking at backing down on the 50% duties on Canada. Looking into it, that doesn't mean that any action is being taken, but we do know there's going to be a meeting with Doug Ford on Thursday in Washington. All right, let's take a look at some of the big movers of the day. Tesla rebounding sharply from yesterday's 15% plunge. That was the worst sell-off in 4 years. President Trump saying on social media that he will buy a new Tesla to support Elon Musk following the growing backlash over Musk's political activities, his extracurricular activities, where he's helping, of course, fund Donald Trump's campaign and now cutting the size of the government as head of the Department of Government Efficiency. And Teradyne, the biggest decliner in the S&P 500 at one point, it lost as much as 21%. The semiconductor test equipment maker is saying revenue this quarter will be flat to down 10% compared with the previous quarter. So again, that stock lower by 17%. Romaine?
And that brings us to our top story today, which is a closer look at tomorrow's inflation report, which requires a bit of a step back in history to 4 years ago on this day. That was when President Joe Biden signed the American Rescue Plan. $1.9 trillion of economic stimulus to bolster an economy that was hobbled by the pandemic. It was a stimulus plan that did exactly what it intended, but with some very unintended consequences. While the American Rescue Plan was needed as the economy was still in contraction. It also came at a time when the labor market, frankly, had already recouped about half the jobs lost during the pandemic, and you had those COVID vaccines that were starting to be distributed through the populace. Now, the American Rescue Plan was intentionally designed to accelerate some of those things by allowing for direct stimulus checks to Americans, a temporary expansion of the child tax credit, and an extension of enhanced unemployment benefits. And it indeed worked. The rescue plan ushered in the longest period of unemployment below 4% since the 1960s. It pushed the poverty rate down to the second lowest on record and pushed household net worth up by an unprecedented $50 trillion over 3.5 years. But here is the big but. Consumer price inflation, which had averaged about 2% over the decade prior, surged to 9.1% by mid-2022. But a lot has changed since, and well, a lot hasn't. Inflation is back down on a headline basis below 3%. But overall prices are still well above pre-pandemic levels. And Bloomberg Economics says tomorrow's CPI report for February is likely to show that while core goods inflation is not accelerating, it's not slowing either. And maybe that's why markets have been on edge. Whatever progress that had been occurring on inflation had already stalled before Trump took office, and now that progress is threatened further by tariffs set to take effect tomorrow on at least $150 billion of goods from Mexico and Canada.
All right, Romain, we do have some headlines out of the White House. The White House saying that there will be no exemptions on steel and aluminum tariffs and that the 25% steel and aluminum tariffs do begin at midnight. Now, earlier, President Trump, during his news conference, had said that he may back off the doubling of these steel and aluminum Canada tariffs from 25 to 50%. And he is looking at backing down on the 50% duties on Canada. But again, the 25% tariffs on steel and aluminum imports do begin at midnight. Romain, you were talking about the CPI report. Let's go back to tomorrow's CPI release. Our next guest expects the core month-over-month figure to come in at 0.3%. That is a step down from January, but still, he says, elevated. Michael Gapen is chief U.S. economist at Morgan Stanley, and he joins us now. So that's the month-over-month figure, but your outlook for inflation over the year is that it will be higher.
That's right. So I think, as you were saying in the lead-in, this will be good news in terms of where inflation is now. So we do think that the year-on-year rate will come down on these 0.3s, which we think will be headline and core. But the real question, like most of the rest of the macro data, is where do we go from here? And the administration has pushed very forcefully in the direction of tariffs faster than we had thought, more of a fast and furious policy implementation. So yes, the risk is inflation, disinflation has generally stalled out. Progress has been difficult. The question is, does it turn around and rise? We think it can, a little bit into year end, which makes the Fed's job more difficult.
Well, the Fed's other job, of course, is maximizing employment. Where do things stand on the employment front?
Well, right now the labor market is still on solid footing. So certainly the employment growth has come down, but 150,000, let's put it in context. We had about 10 years of that after 08-09, and we called that a recovery, right? So 150,000 jobs a month is still a good labor market. Labor market income growth is running about 5.2% in terms of the product of employment, hours worked, and average hourly earnings. So the labor market's kicking off income above the rate of inflation, which should help support spending. But again, this is a current number. Tariffs tend to increase inflation now, but weigh on activity later.
So how much later?
Typically 2 to 3 quarters. But, it's hard to know exactly. The more forcefully you push, the higher you put them, probably the more you front load that response. So I think the risk is maybe it shows up sooner.
Well, that's what I'm curious about, Michael. So if these tariffs, or the tariff announcements, we should say, had been rolled out sort of in a more elongated way, and in a more organized way,
right,
would the economic impact be different?
I think yes, because I think what you're getting at is the uncertainty. Where are we going? Who are these on? At what rate? What's the purpose? Right. So even if it's on again, off again, maybe it's okay that the tariffs never go in, but the threat of them, the perpetual threat of them, not knowing what the playbook is, does mean uncertainty is elevated and it's harder to make business and consumer decisions.
Well, this brings me to my question then. As an economist, how do you model for something that's still kind of esoteric? The idea that expectations or feelings may be worse, but the economic activity itself isn't necessarily worse. When do those two collide?
I mean, honestly, it's difficult to model. I would cut it this way. Higher uncertainty alone is unlikely to create a recession.
Okay.
But what it does is it means corporations and households wait. They postpone hiring and spending plans. So the good news is that means nobody's getting overextended. Right? If you're conservative, you're not getting overextended. You're not primed for a pullback. But so what I would say is you would need another trigger, like significantly lower equity markets, for example, to turn that uncertainty into a downturn.
But just on that point, though, I mean, when we heard from the CEOs of Delta and American over the last 24 hours, I mean, that's material. If I decide I'm scared or I'm just feeling uncertain about the economy and I either cancel a trip or just decide not to book that summer vacation that we would normally take, does that not have the potential to be recessionary?
Yeah, here I would say it gets into the question of how long uncertainty lasts.
Gotcha.
Right? You can imagine a bout of uncertainty that gets resolved in a relatively short period of time, then activity can resume. Gotcha. But if it's very prolonged, if we're talking several years of prolonged trade policy uncertainty, then yes, ultimately it would have an effect.
So what assumptions are you making then in terms of how long that uncertainty lasts for? Because we have midterm elections coming up, and presumably the administration is pushing really hard because it wants to get all of this done before the re-election campaign season really gets going.
Yeah. So we had assumed that the tariff story and trade protectionism story would extend at least through the middle of 2026, just for that reason. That they have control of Congress for 2 years. So if you're going to make your significant push, you probably need to do it in the first 2-year time horizon. So we think, yes, it will extend roughly over a year longer from where we are today.
So that suggests that the uncertainty and the delay that consumers and investors and businesses are putting off will extend until then as well. Is there any historical parallel to that? Have we been here before?
Well, the only recent parallel is 2018, 2019, right? So there.
But the economy was in a different place then.
It was in a different place, but in terms of effects of tariffs, then you're going back to like the 30s. Right, very different world, very different economy. So we really only have that one episode. And there I would just say we started putting on tariffs in January, but manufacturing output didn't start falling until October. But when it fell for 12 straight months. So that's where you're thinking it boosts inflation now, weighs on activity later, but we just have one example of what that cycle looks like. It could turn out to be very different. Small sample pool.
All right, so I'm going to ask you about the big Fed meeting that's probably not going to be so big. And I know that the Fed doesn't plan to do anything, at least that's what they've telegraphed. But they do have to telegraph something, I would think, or at least Powell's going to get peppered with a lot of questions. Right. What do you actually want to hear from him? Like, what would actually be meaningful for you to hear come out of his mouth?
Well, I think it's hard for him to say anything that's meaningful because of just, there's kind of 4 buckets of policies that are coming, and they see some of them as good for growth, some of them as not so great for growth, some might be good for inflation, some not. So they're like, we don't know. We don't know what to say because we don't know. So I guess the main message would be, patience. We're not prejudging this, but I think somewhere in there, they are inclined to say, we'll probably end up responding to weaker activity, right? So essentially, it's will they respond to inflation or activity? We're all betting at some point they're going to react to weaker activity.
But does this create the risk that we end up back where we were in 2021 when we saw inflation, we saw the whites of inflation's eyes, and the Fed just kept saying, don't worry, it's transitory, it'll all sort itself out?
Possibly, yes, right? So we just went through a few years of inflation well above 2%, as you said on the lead-in. And maybe inflation expectations are more fluid now. So if you get what we'll call a drip, drip, drip of tariffs, doesn't feel like a drip, 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 feels like more
fire
than
hose.
That. If it's a repeated fire hose effect of tariffs, then you get an even more prolonged period where inflation is higher. That's why, for the time being, they need to sit on the sideline while they evaluate that impulse. And then ultimately, if the economy softens, they'll react to that. So it could be. The markets are looking for a lot of Fed cuts this year, and it may be a case where the Fed disappoints it.
Are we still looking at 3? Does that sound reasonable to you?
I think that's a weighted average of things are okay plus things aren't okay. So I think in a things are okay world, then the Fed maybe cuts once, but obviously if there's a recession, they end up cutting a lot. So I think that's a weighted average of outcomes that the market doesn't know which one to price right now.
All right, Michael, got to leave it there. Michael Gapen, Chief U.S. Economist over at Morgan Stanley.
All right, coming up, we've got the top three, where we focus in on the top three movers and shakers at the center of the day's biggest stories. This is The Close on Bloomberg.
Season is here.
It's quite remarkable what we've seen over the past few weeks.
That's so exciting. Earnings season.
Bloomberg is first to break the numbers.
Alphabet earnings crossing the wire.
We do have some headlines from Redfin.
Taking a look at Snap, more earnings rolling out.
With the smartest insights.
Economic growth is the driver of earnings. Earnings are the drivers of stock markets.
When you are priced at perfection or close to perfection, then I think there's a lot more scrutiny.
Continuing coverage on Bloomberg.
It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Ivan Espinosa. He is the current Nissan Chief Planning Officer, and he is set to take over as CEO of Nissan, the struggling Japanese automaker. This will happen on April 1st. Nissan has a long laundry list of things it needs to do.
Yeah, I mean, Godspeed to this guy. But it's kind of interesting. There's been obviously a lot of palace intrigue about who would lead sort of this next leg of what Nissan is trying to accomplish here. And I didn't know a whole lot about this guy prior to today, but at least on paper, it sounds like he's got the chops, but he's got a big job ahead of him.
Yeah, they need to find a financial backer. They need to stabilize their business. This is after the merger with Honda fell apart.
All right, I'm keeping an eye on none other than Eldridge Tiger Woods. Breaking news. He just posted on social media that he actually had surgery on Tuesday on his Achilles tendon. This, of course, threatens to keep him out of play this year, including the Masters tournament, which was just set to take place about 4 weeks from now. And, of course, we should point out he's 49 years old, obviously a phenom. He's been at this for 30 years and widely considered to be the best, or at least the second best golfer of all time. But he's had a lot of trouble trying to get back on track, trying to get back in those winning ways. And at 49 years old, with surgery on his Achilles, Scarlet Fu, I mean, I don't want to count him out, but I don't know. Is this it?
I think the record might be over, because last year he set the record, the Masters record, by making the cut for the 24th time in a row. But this year he hasn't really competed outside of the indoor league, the TGL. So, maybe it's time for him to focus on rehab and rest, as he's put it.
Well, according to the Associated Press, they're saying this was a minimally invasive Achilles tendon repair. And they said it'll take about a month before he can actually put weight on his foot.
So probably not going to be at the Masters April 10th to 13th. All right, third on the docket is the Lego CEO, the toy maker, posting record sales with the man at the helm shrugging off tariff threats. The CEO actually saying, if we can sustain this level of growth, then tariffs are not the biggest problem. Key thing here, Romaine, is that Lego is privately held. It's not a publicly traded company, so they don't need to reveal all these numbers.
They don't. But of course, there's been a lot of speculation here. Obviously, a big Danish company, and there's a lot of speculation about other big Danish companies, hint, hint, like Novo, and this idea of whether these tariffs would have a material impact on things that we know and love, like GLP drugs and Legos.
You're putting them in the same category?
Why not? Sure.
All right,
we're going to keep the conversation going on the tariff front, because, of course, that has been front and center for markets. Just hours away from tariffs kicking in on aluminum and steel, we're going to get views from Canada, from Mexico, and China. That's coming up after the break, right here on The Close, right here on Bloomberg. The White House announcing just moments ago that they will move forward with a 25% tariff on steel and aluminum imports starting at midnight. Now, that is a back down from the threat of a 50% tariff earlier today. This after Ontario agreed to suspend a 25% surcharge on electricity sent to the U.S. I know it's a bit confusing, but here to kind of sort it out for us is Jon Erlichman, who is in Toronto here for BNN Bloomberg. And John, I'm not sure what to make of this. We apparently Doug Ford, the Ontario Premier, made some concessions. So Trump is backing off. That 50% tariff, which just kind of materialized today, is now only going to be 25%. What's the view from Canada?
Well, look, it's been a whipsaw day, no matter how you slice it, Romaine, because you've got a lot of steel and aluminum producers who are trying to figure out their plan B. But you're right. It looks like for now, the worst case scenario is avoided. Now, the White House has confirmed that those tariffs at 25% go into place tonight. But you're right. Earlier this afternoon, the president had been threatening 50% tariffs. You mentioned the province of Ontario and the Premier Doug Ford, who has been trying to stand strong for not just the province, but for Canada, and had those 25% surcharges on electricity that goes to key states, including New York. He has now backed away from that. Remember, the president was also, because of those surcharges on electricity, starting to talk about hitting the Canadian auto industry and the auto parts makers hard unless there were changes on dairy tariffs, which is a very complicated subject. So you saw a lot of ripple effects in the Canadian stock market with some of the auto companies. For now, obviously, a worst case scenario avoided, but that doesn't mean that you don't have, as an example, steel companies like Algoma, which is in Ontario, which spoke to BNN Bloomberg today and said they're trying to find new markets for their product.
Good points. And we should mention that Doug Ford, the Ontario Premier, and President Trump will be meeting Thursday in Washington. You had said that Ford is standing firm on behalf of Ontario as well as Canada. There is a new Prime Minister designate in Canada, Mark Carney. What has he said with regards to tariffs imposed by the U.S. and how Canada will respond?
Well, I'm glad you brought that up, Scarlett, because it is such a complicated matter where you have, on the one hand, as you mentioned, the Premier of Ontario planning this conversation with the Commerce Secretary Howard Lutnick in Washington later this week. We don't know officially when Mark Carney, the incoming Prime Minister, will take that job, but it will be very soon. And his comments on social media today essentially reflected what Canada's stance has been so far, which is until the U.S. backs away from all tariffs and is ready to talk about free trade, Canada is going to keep some of its tariffs in place. We'll also have to watch very closely what happens when he officially comes to power, because, Scarlett, he's likely going to be calling an election very quickly, and we'll watch that. The other thing to watch, just on the economic front, we've got a Bank of Canada interest rate decision tomorrow. Given all of this, I know a lot of people are trying to figure out what it all means for the U.S. economy. People are pretty clear that the recessionary risks in Canada grow by the day, and it is expected the Bank of Canada is going to cut interest rates again tomorrow to try to navigate the uncertainty in the meantime.
Yeah, thank you for folding in the Bank of Canada and its policy move for tomorrow. BNN Bloomberg's Jon Erlichman, thank you so much joining us from Toronto. Now, Canada's Energy and Natural Resources Minister Jonathan Wilkinson is issuing a warning on Trump's tariffs. He says it's bad for both sides, and he urged for more constructive conversation. He sat down with our Alex Steele in Houston for Sarah Week. Take a listen.
First of all, I think this tariff conversation is really unfortunate. We've been long partners, friends, allies, and our economic relationship has benefited both parties. So these tariffs are actually going to create pain on both sides of the border. I would say for Americans, we're already seeing domestic steel prices go up significantly as a result. And the United States only produces 20% of the aluminum it consumes. So you're tariffing things that you're going to have to import at a higher price. So to be honest with you, the economics around this are bad for both parties. And I think we got to get back to having a better conversation about how we work together.
How do we calm this down right now?
Well, I think we need to try to find ways to get back to a conversation about how we create more benefit by working together. So I've been pitching this concept of a critical minerals alliance, which is really about a number of very specific projects that would allow us to help the United States with some of the needs it has, reduce dependence on China. China is our common adversary, but would do so in a manner that actually would create economic benefit on both sides of the border as a bit of an off-ramp away from this conversation about tariffs. I continue to pitch that. I met with Secretary Wright this morning, and we had the conversation about that.
Was he receptive? Did he listen?
Well, he listened. He's a very smart guy. I mean, and he's actually somebody who knows Canada well. He used to run a company that had operations in Canada. I think we're all desirous of finding a pathway back to a more constructive conversation, because at the end of the day, this is going to be lose-lose.
Is there a dollar? How far are you along in those conversations about a critical minerals deal?
Well,
ninth inning?
Yeah, I mean, what we're talking about isn't a broad-based critical minerals package. It's basically a number of very discrete projects that we could execute on in the relatively short term that would create benefit. And so, those are the kinds of projects that actually could come to fruition quite quickly. But in order to do that, we need to actually stop with the tariff conversation and start with the more constructive conversation.
Jonathan Wilkinson there, Canada's energy minister, sitting down with our very own Alex Steele down at the CERAWeek event in Houston, Texas. Meanwhile, our other North American neighbor, Mexico, is also working out how to navigate more tariffs. Joining us right now is our Mexico Bureau Chief, Carolina Millan. And Carolina, I know the economy minister of Mexico has been on the ground here in the U.S. for the last 24, 36 hours. And we heard from Claudia Sheinbaum, I believe, yesterday, saying that she was confident that she thinks that Mexico can at least avoid some of this retaliatory tariff tit for tat. Has there been any progress made in those negotiations between the two sides?
Yes, it's really interesting to see how the Mexican approach has been very different from the Canadian one. And we're seeing these conversations are taking a much less confrontational tone. As you said, in her Sunday rally with supporters at the iconic Zócalo Square in Mexico City, President Sheinbaum emphasized the work that's been done with the U.S., but also the fact that because there aren't currently any tariffs with the U.S., because the two countries have been such close trade partners, there wouldn't be, if there's reciprocal tariffs, that wouldn't apply to Mexico. And that seems to be a key thing that the country is banking on, the existing relationship with the U.S. and the work that's happening on the ground regarding migration, stopping migration flows, increasing security on the border, and of course, continuing to have these conversations on trade.
And Carolina, part of the way that President Sheinbaum has brought Trump over to her side and aligned their interests is to point out that together they are a formidable team against China. What is the latest when it comes to Mexico's tariffs on Chinese imports?
So I think that seems to be one of the ways that Sheinbaum has managed to win Trump and his team over, by showing that they want to strengthen North America and the North American bloc. And so we have heard that this is part of the pitch that some of the ministers have brought to the U.S., that the countries want to work together as a united front against China. We haven't yet seen progress on the specific Chinese tariffs, and that seems like it's on the table and something that we should be keeping an eye on in the coming weeks to see if the negotiations get to a point where Mexico does indeed go forward with this proposal.
All right, Carolina Millan, thank you so much for bringing us the angle from Mexico. As we've been talking about, China also feeling the wrath of Trump's tariffs, but not much progress, if any, has been made between Beijing and Washington on the best way to proceed. Joining us for more on this is Zongyuan Zoe Liu. She is Senior Fellow for China Studies at the Council on Foreign Relations. Zoe, thanks for joining us. What's been interesting is even as people have been questioning whether Trump will move forward with the tariffs on Canada or Mexico, and there's been a lot of headlines on whether he's going to oppose it or back off or delay, there's been no question over whether they're going to move forward with the China tariffs. What is the state of negotiations, if at all, between China and the U.S. right now?
Yes, Scarlett, thank you very much for having me. Right now, remember Bloomberg News correctly reported that the negotiations right now are being stuck, even at low levels. And I think that is an accurate description. Although there were stories saying that President Trump and President Xi Jinping, they may meet in June, or for that matter, planning a summit around that time. But so far, really, there has not been any clear signal, either from Washington or from Beijing, that the two sides will reach a grand deal. But right now, I think, Beijing is very busy with the annual two sessions. So from that point of view, it probably understandable why there has not been a lot of progress moving forward.
So at what point does this become a bigger priority for Beijing to address? Because the economy has been struggling a bit. And yes, they came out with some pretty aggressive targets for growth for the next year, 5%. And it's been around 5% for a while here, along with some fiscal measures designed to support the economy. At what point does this become priority number one, where Xi Jinping and his team will start making more inroads into discussions?
Scarlett, you are right. The Chinese government set the growth target for this year around 5%. And I'm afraid that for the Chinese government at this particular moment, perhaps reaching a trade deal with President Trump or with Trump's administration may not necessarily be the top priority. Beijing's priority right now is to focus on stabilizing the economy, especially by prioritizing self-sufficiency, both in terms of technological development and restructuring the Chinese economy such that it can endure trade tensions. So from that perspective, perhaps negotiation with Trump is not necessarily on Beijing's top priority list, especially considering that President Trump has been framing tariff on China as one important reason is because of fentanyl flows from China. And from Beijing's perspective, fentanyl is not a top priority for Beijing, and there is no grand strategy to poison America from the Chinese government.
So, Zoe, what is China's trade relationship with the rest of the world? I mean, I understand where it stands right now with the United States, but I mean, China is imposing retaliatory tariffs on some Canadian goods, and that's part of a long-standing dispute that predates the Trump administration. And I am curious as to how much Xi Jinping has shifted this economy internally, given what he learned during the first 4 years of Trump back in 2016 and beyond.
Back in 2016, and or for that matter, in the context of the first trade war, at least Beijing realized that a good Trump visit may not necessarily promise good trade relationship. Remember, back in 2017, Trump visited China, and then within a year, Trump waged the first trade war with China. So from that point of view, Beijing has been preparing for the return of Trump for at least the past few years. And on top of that, if we can take a page from the first Trump administration in terms of what China has learned, China learned that it has to expand export market with developing countries. And this time around, not just the Chinese government will continue to do that, Chinese companies, because of intense domestic competition, because of profit margin is so thin at home, Chinese companies, they are very much motivated to expand overseas. So from that point of view, if we think about where China stands is 30% of global manufacturing, it is going to continue expand market overseas.
How much of all this ties into the recent excitement we've seen in China about artificial intelligence and the broader tech ecosystem? We've seen some old faces back in the fold like Jack Ma. We've seen new companies or relatively new companies like DeepSeek make a play. And there was an interesting note out from Citigroup here in the U.S. that downgraded its outlook for U.S. stocks, but as a pairs trade, upgraded its outlook for the Chinese market.
You know, Roman, that is an excellent point. In a lot of ways, the Chinese government, they do view artificial intelligence, or for that matter, digitization and smart manufacturing as a solution to China's structural economic challenges, from demographics to weak domestic consumption. And in terms of promoting domestic consumption, this is where the Chinese government, in fact, has been giving credit, consumer credit, if they buy smart devices. So from that perspective, I do see there are a lot of potential market expansion, even domestically, among domestic Chinese consumers, to expand consumption in this specifically designated area. But in terms of broad-based consumer market expansion, the potential for growth is actually very limited. And just a final note, China's Ministry of Information and Technology, they actually put out 10 strategic scenarios to promote artificial intelligence application. So in a lot of ways, it is, you are right, Roman, it is an ecosystem.
All right, Zoe, always appreciate the conversation. Zoe Liu over at the Council of Foreign Relations there, as we keep an eye on tariffs set to kick in on steel and aluminum, which would primarily affect Canada, a smaller extent Mexico. Of course, those 10% tariffs on China already did kick in, though more to come if you believe what Trump said. But I want to go back to the market here, because China's market, whether you're talking about the Hong Kong market or the mainland market, it's outperformed the U.S. by a pretty significant margin.
Well, to be fair, everything's outperformed the U.S.
Up about 3% here in Hong Kong, 2% on the mainland. You compare that to the downdraft we've seen in the U.S., and I know some of that's valuation. Obviously, the Chinese companies, their valuation is starting from a much lower point than here in the U.S., but I do wonder if there is some substance to this upgrade that we saw out of Citi and a downgrade for the U.S.
Well, people were basically not owning China, so even a little bit of money rotating into China will provide some kind of noticeable boost, whereas most everyone was overweight, and maybe in the next couple of weeks and months, downgrading to neutral. So
Yeah.
there's a lot of money here at play. In terms of what happened today in markets, it was all over the place. We did end lower by 0.75%. So a second day of losses here for the S&P 500. At one point, we're lower by 1.5%, and the S&P 500 entered a technical correction down 10% from its high. We're not there yet, so we didn't close below that level, but it's something we'll be watching for tomorrow. And you can see the VIX also eased down to below 27. Of course, we continue to see money moving into treasuries, or I should say yields moving higher, money moving out. And in terms of the Canadian currency, that too has been all over the place. Really unchanged at the moment here as everyone tries to figure out whether the 50% tariffs have been rolled back formally or not.
Yeah, I don't think anyone knows that. Well, there's one person who knows that. But
I don't think he's decided yet.
Maybe he'll tell us in the morning.
This is The Close on Bloomberg. President Trump is scheduled to address top business executives in the next hour. The meeting with the Washington-based Business Roundtable is set to include CEOs from companies like Cisco, JP Morgan, and Citi. Joining us now to discuss is Bloomberg's Balance of Power co-host Kailey Leinz. Kailey, can you give us some context for this meeting? It certainly seems like it's very timely given the confusion over the tariffs and when they're going into effect and how much they're going to go into effect by.
Yeah, Scarlett, these are quarterly meetings that the Business Roundtable holds with the executives that comprise it, but unclear at what point it was decided that President Trump would be attending this evening or that his remarks would be covered by the press pool. Usually these things are pretty closed doors. We saw when he visited the Business Roundtable when he was campaigning in 2024. Of the issues, though, that are expected to come up, I think you all could probably guess, considering he's going to be addressing the likes of executives who represent big banks who are sensitive to capital markets and economic activity, companies like Target and Walmart, even GM, which are sensitive, of course, to the tariff story, and all of them corporations that are probably wondering what exactly is going to be happening with the tax code come the end of the year and whether a corporate tax rate, as he previously voted to the Business Roundtable, will be included. We did get some preview of the kind of economically oriented remarks President Trump could be prepared to give when he spoke to press at the White House earlier today, pushing back on the notion of a recession, saying he doesn't see that. He thinks the country is going to boom. And of course, we just got confirmation from the White House in a statement that he is going ahead at midnight tonight with 25% tariffs on steel and aluminum, though that is also the rate that will apply to Canada after earlier today he was suggesting he could hike it to 50% for our northern neighbors.
I am curious, though, Kailey. I mean, when we talk about all of these executives gathering and having a forum with the president, we've seen a lot of executives individually go down to the White House or Mar-a-Lago to make their case for one thing or another. If the press is there, how candid do you think they're going to be about their concerns about Trump's policies?
That's what we've been discussing internally all day, Romaine. It's not clear, I should say, based on the guidance we got from the White House, how much of this will actually be public and allowed to be seen by the press, or if any of this will go behind closed doors at some point. The president very well could just make some opening remarks, and when it comes time for the back and forth with executives, we not be privy to that. We're just going to have to see how this goes down, as the guidance has been very unclear from the folks in the administration. But I would point out we have seen some interaction between President Trump and business executives, including right after his inauguration when he virtually joined the World Economic Forum at Davos and had the opportunity to be questioned by the likes of Brian Moynihan, the Bank of America CEO, and it quickly turned into the president accusing Bank of America of debanking conservatives. So that, Romaine, to your point, is the kind of risk an executive might open themselves up to if they do want to get some honest responses from the president on the policy issues that they are concerned about.
Yeah, and Moynihan's response to that grilling was probably said more than the question itself. Kailey Leinz, the co-host of Balance of Power, which starts at the top of the hour. They have a lot to cover, not only that Business Roundtable meeting, Scarlett, but we're expecting potentially a vote in the House of Representatives tonight on a stopgap budget measure. I kind of forgot. Did you know there's a government shutdown looming?
It feels like there's always a government shutdown looming, so we've kind of gotten used to that.
All right. Well, it's supposed to happen this week unless the House can actually agree here on a budget measure. This is a stopgap funding, basically a CR, continuing resolution. Mike Johnson says that they have enough votes. Obviously, he only really needs the Republicans to sign off on it. He doesn't really need Democratic support.
But he needs every Republican to sign off on it.
That's the thing. It looks like they might. I mean, J.D. Vance has been on the Hill all day, apparently, according to Bloomberg reports, whipping folks, if you will, to support things. But it gets to this question, though, too, is whether this just kicks the can down the road and investors are then going to have to worry about a government shutdown, I don't know, 3 months from now or 6
It
months
most certainly
from now.
kicks the can down the road.
Yeah.
And the question is whether the Senate would be able to vote before Friday night's deadline to avoid any kind of funding lapse. Just how smooth this will be or whether there will be a hiccup. But kicking the can down the road, I think that's in the bag.
Yeah, it'll be interesting to see. But just one more thing, of course, that this market is going to have to keep their eyes on. That is coming up on the weekend. We're going to set you up for what could potentially move the market over the next 24 hours. When we come back, this is The Close on Bloomberg. It's only Tuesday, Scarlett.
I know.
All right, there's going to be a lot going on tomorrow as well, setting you up for what to watch. 12:01 a.m. Eastern Time. Those Trump tariffs on steel and aluminum are set to take effect.
25%, although the 50% one on Canada and Canadian steel aluminum, still a big question mark.
At 8:30 a.m. Eastern Time, we're going to get a big read on consumer inflation here in the U.S.
Month over month, 0.3% is the estimate, and year over year, it will be 2.9%, core 3.2%.
The effect of tariffs won't be reflected in that. However, maybe Bank of Canada and their rate decision, I feel like they're going to have to address this.
Yeah, they're expected to cut rates by 25 basis points to 2.75%.
We're also going to get a Starbucks annual shareholders meeting, the first for the new CEO, Brian Nichols, and we get several earnings tomorrow as well.
Yeah, Adobe will be reporting, American Eagle, and SentinelOne. Did you know the ticker is S?
Yes.
That was new to me. I didn't realize that.
Yeah, that's the old Sears sticker.
I know. That's what I was thinking.
Thank you, Eddie Lambert. All right, be sure to tune in for all of that. We'll have all of your market-moving events, a focus on Washington, and a focus on Wall Street right here on The Close on Bloomberg.